Toa. I'm a sophomore studying government at the college, and I'm a member of the JFK Junior Forum Committee at the Institute of Politics. Before we begin, please note the exit doors, which are located both at the park side and at the JFK Street side of the forum. In the event of an emergency, please walk through the exit closest to you and congregate in the JFK Park. Also, please now take a moment to silence your cell phones. You can join the conversation tonight online by tweeting with the hashtag JFK Junior Forum Live, which is also listed in your program. Now, please take your seats and join me in welcoming our guest, Robert Glauber.
All right.
Oh, thanks very much. Good evening. As some of you may know, I'm a member of the faculty of the Center for Business and Government here at the Kennedy School. I'd like to welcome all of you to this year's NASD lecture on financial regulation. I want to thank my former colleagues at FINRA, the successor to NASD, for their continued sponsorship of this lecture series. We're most fortunate this evening to welcome Heath Tarbert, recently appointed as Chairman CEO of the CFTC, the Commodities Futures Trading Commission, the regulator, as I think most all of you know, of commodities, futures, swaps, and options markets. For those of us at KSG, Heath's career, which spans private practice as a lawyer and public service in a number of senior financial policy and regulatory positions, is really a paradigm, the career path for our graduates. Prior to his new post at CFTC, Heath served as acting Undersecretary of the Treasury for International Affairs, and prior to that was Assistant Secretary for International Markets. As part of his Treasury roles, he served as Policy Chair of CFIUS, which is the committee responsible for dealing with foreign investments that raise national security issues. He was also U.S. Executive Director of the World Bank. Earlier in his career, he served as Associate Counsel to the President in the George W. Bush White House. Heath's career and preparation for it started with the JD and SJD degrees from the University of Pennsylvania Law Schools and a DPhil from Oxford in comparative law. Along the way, he served as clerk for Justice Douglas Ginsburg of the D.C. Circuit Court and Justice Clarence Thomas of the Supreme Court. Here at Harvard, he was Executive Director of Research for the law school-based think tank, the Committee on Capital Market Regulation, of which Professor Hal Scott, who's now here at the Kennedy School, is head. I teach with Hal, and I'm on the board of that committee. And of course, when Heath was here in Cambridge, I got a chance to know him really quite well, and it was really the foundation for my very deep respect for him. And in the private sector, Heath was head of bank regulatory practice at the law firm of Allen & Overy in D.C. This evening, Heath's going to talk about rules for principles and principles for rules, making sense out of financial regulation. I think many of you, particularly those of you from the Kennedy School, will know the tension between developing financial regulation, or indeed any regulatory standards, based on detailed and specific rules versus general principles. As an example close to Heath's heart, I think SEC regulations are mainly rules-based, as are U.S. accounting standards, while the CFTC's regulations are principles-based. And it really does make a difference. Heath will talk a little bit later about some of the differences in approach that had an effect on the financial crisis. So without further delay, let me introduce Heath, and thank you very much for coming.
Thank you. Well, thank you so much. It is really terrific to be here tonight. Before the presentation, we get into the meat of it, I'm supposed to say this disclaimer. The opinions, analysis, conclusions expressed herein are those of the presenter, that's me, and do not necessarily reflect those of the commissioners or the commission itself. But one day I hope they will. So I'll just put that out there. One thing I don't have to disclaim, however, is the admiration I have for Bob Glauber. Bob is truly a legend in both financial regulation as well as public leadership. So I could actually spend 2 hours going through all of Bob's career accolades, so I'm not going to do that tonight. But one of the things I will say is that at least throughout my life, and many others with whom I've spoken have said, apart from family and friends, one of the things you cherish in life are mentors. And I am privileged to have had Bob as a mentor. And it's not just me, by the way. I know for many of you, Bob is a current mentor, but his mentees include the chairman of the Federal Reserve System, the vice chairman of the Fed for supervision, a former SEC chairman, and the list goes on and on. So I will just say that the United States, Bob, is lucky to have had your leadership in government during those years. And this university is particularly, I think, honored to have had over 50 years of your service. So thank you so much, Bob. It's an honor to be here. So tonight I thought, as Bob mentioned, I would talk about two basic types of regulation, what we call principles-based regulation and what we refer to as rules-based regulation. Explain what they are, talk about the advantages and disadvantages of each, and then, for the first time in a forum, sort of talk a little bit about how you would choose each approach. What are the factors? In other words, what are the principles for rules and what are the rules for principles? And then finally, I wanted to share with you some actual real-world applications, things that at the CFTC we're actually working on, where we have to make decisions as do we think about it in a rule-based way or do we think about it in a more principles-based approach. So why am I here at Harvard? Well, I'm here at Harvard because I'm surrounded by some of the brightest minds in the country and throughout the world, and many of you are in this room. And so my hope is that by introducing some ideas here, I might get some feedback from all of you. You might even think about continuing research and discussion about it, so we can learn from all of you. And I will note that the mission of the Kennedy School, which I think is incredibly articulate and elegant, the very last line of it says that the reason the Kennedy School exists is to have an impact on solving public problems that no other institution can match. And so I figured what a better place to come and talk about this than right here at the Kennedy School. So let me set the scene a little bit before we dive in on explaining to you, Bob did a great job of it, but I'll just talk about it a little bit more. Who is the CFTC? What I often say is the CFTC is probably the most important financial regulator many people have never heard of. The mission of the agency is to promote the integrity, resilience, and vibrancy of the U.S. derivatives markets through sound regulation. Now, I've worked with all the financial regulators in the United States in one form or another. And what makes the CFTC, I think, really unique is because the derivatives markets touch on all the underlying markets, we effectively regulate everything from corn to crypto. So we have to know about agriculture, about energy, about financial markets, and now we find ourselves learning more and more about digital assets. So that, I think, makes the CFTC really unique because derivatives essentially touch everything. Our vision of the agency is to be the global standard for sound derivatives regulation. So both the mission statement and our vision statement, which we just created only a few weeks ago with the entire staff of the agency, both of them use that term sound regulation. So what is sound regulation? Well, the best I can explain it is sound regulation is about using the right tools at the right time for the right reasons. And so one of the ways that we're focused on ensuring we use the right tools at the right time and for the right reasons are first distinguishing between how we regulate, because how we regulate in many ways is just as important as what we regulate. So the CFTC, as Bob noted, has a unique history and tradition of being a principles-based regulator. And this was codified by Congress. Congress recognized this importance in something called the Commodity Futures Modernization Act back in 2000. Where we took a series of core principles that govern our exchanges, as well as govern our clearinghouses, and we essentially codified them into law. At the same time, our fellows in the UK were doing something very similar. The Financial Services and Markets Act of 2000 also created a principles-based regime. And the interesting thing about principles-based regulation is that it's not really ideological in the sense that, and I'm not going to read all of these quotes, but there are a number of former chairmen, and you can't see all of these quotes either, including Chairman Massid, who is a fellow here at the Harvard Kennedy School, and he was President Obama's second CFTC chairman. All of them, reported by President Clinton, President Bush, President Trump, all of them have said principles-based regulation is a really important tool for our markets, and they're really important. And in fact, one of the other interesting features is that after the financial crisis, and these quotes date from before the financial crisis and after the financial crisis, the CFTC was the only regulator not to lose jurisdiction and arguably not to be criticized. In fact, the CFTC, what happened was Congress said the entire swaps market is largely unregulated, and we want you to take the approach that you've been using for futures and options and essentially apply that to swaps. So it was in many ways a validation of the principles-based approach that the CFTC had been taken for a number of years. I look at this picture and I say in many ways that is the metaphor for being a financial regulator. It's a pretty perilous job. The goal, the whole entire point is to, quote, stay ahead of the curve. Now there's only one thing that's worse than falling behind the curve, and that's getting wiped out by it. And there's a very real chance that can happen if we don't keep up and we don't approach new markets. And one of my goals is to reinvigorate a principles approach because of the reasons that I'll state herein. A principles approach is one of the tools that you can use to really stay ahead of the curve when things are rapidly changing. So what is principles-based regulation? Well, principles-based regulation has a high level of generality. It's flexible and it can be applied broadly. It focuses on outcomes, not specific conduct. It's generally qualitative rather than quantitative. It's also susceptible to elaboration. So when you have very specific rules, they become ossified. They become frozen in time to some extent, whereas a principles-based approach can be allowed to evolve over time as markets and behaviors change. So let's just use some simple examples from outside financial regulation. Classic rules-based approach. There you have it. Principles-based approach. Now some of you are shaking your heads and saying, we can't have this in Massachusetts. I get it. But later in my presentation, I'll provide some examples for when principles, again, make sense and where rules make sense. The other thing to talk about and make clear to everyone is what principles-based isn't. Principles-based is not light touch. Light touch regulation really isn't regulation at all, in my opinion. It's more of a monitoring function. Principles-based regulation is also not a euphemism for deregulation. And you see there in the picture the guys in prison are saying, I wish we'd had light touch regulation. What are the advantages of principles-based regulation? Well, a lot of these are somewhat intuitive. I think there's a general consensus that we've had a little bit of information overload in terms of rules. I think there's also a consensus among everyone that for risk and other types of features involving our financial system, we shouldn't treat Main Street institutions the same way we treat Wall Street institutions. So things have gotten a little bit out of hand. So for example, this is a funny little, if you can read that, it has an investor sitting at the table saying, could you please bring me the new investing regulations you downloaded yesterday? And the colleague says, it's still downloading. Regulation has grown quite enormous, tenfold increase since 1950. Winston Churchill, of course, said, if you make 10,000 regulations, you destroy all respect for the law. A principles-based regulation approach sort of dispenses in some ways with the need for detailed rules and regulations that dictate every aspect of a firm's possible behavior. So this right here is a picture of all of the financial regulations in Titles 12 and Title 17 of the Code of Federal Regulations. So it comprises the banking and securities regulations as well as the commodities regulations. Anyone want to guess how many pages this is? Over 13,000, and that's pages. So on each page, obviously, there are a number of regulations. So we can only imagine what Winston Churchill might say. So again, not saying that rules-based doesn't necessarily make sense, but what I'm going to try to articulate is when it makes sense and when principles make sense. So what are the key advantages of a principles-based approach? Well, number one, obviously simplicity. A few principles can cover a lot more ground and reduce complexity. Flexibility, it's much more adaptable. It avoids over and under inclusion. The moment you write a specific rule, you're excluding things and you're including things that maybe you didn't want to include. It promotes innovation because it allows flexibility. And this is an important one. It discourages loophole behavior. We've had a number of situations where accounting rules and other types of tax laws have been very, very specific. And the overarching point of why we have these things is often lost. And so people quote unquote comply, but they undermine the whole reason for the thing to begin with, the reason the regime is there to begin with. It also creates a better supervisory model. If something is principles-based, it actually makes a lot more work for the regulator. So you're constantly working with the regulator to understand how they're complying with your principles. The other thing it does, particularly in a globally interconnected world, is it facilitates international cooperation. Higher level principles can be much agreed upon in a much more easier way than detailed specific rules. That said, principles-based regulation has some downside, and there are some advantages to rules-based regulation. And in fact, many people on both the libertarian right and I'd say the far progressive left have actually criticized principles-based regulation and said you should go with rules-based regulation. And there are some points that are important that we need to take into account. So what are the key advantages of rules-based? Well, obviously, greater clarity. Being more specific leads to more consistency because everybody knows exactly what you expect from them. It avoids retrospectivity. So in other words, it's a lot easier to know when you're about to violate a specific rule than whether or not you're going to violate a principle. And you only find out that the regulator disagreed with you and you violated the principle later on in time. So a lot of people have said, it's better now, I'd rather know. This is what I'd call the dark side of flexibility. You know in advance whether or not you're going to violate the regulations or not. It also protects against some private lawsuits. So you have a situation that if you have private lawsuits for certain financial behavior, and there are no clear regulations, there's principles-based, you end up with the problem that lawsuits can actually create the regime for you. So if you actually have a detailed rule book and someone accuses you of you did wrongdoing, you can point to it and say, no, we did follow the rules. The other interesting thing, and this is really important because people have said one of the potential issues with principles-based regulation is not a race to the bottom, but rather a race to the top. That if you use principles-based regulation in a certain set of circumstances, it tends to sometimes blur minimum standards with best practices. And so you end up with people saying, in order to comply with the principle, I need to use the gold standard. So that's really interesting. So those are some key advantages of a rules-based approach. But then the question becomes a very practical one. Well, how do we choose? How do we choose which approach to use? And we've reviewed some of the academic literature, some of the other literature, and no one has given us a set menu and said, here's how you do it, Mr. Regulator. So what we have done and what I've thought about is to propose to all of you tonight a framework for starting to think about how you choose rules versus principles. The first thing to mention is it's not a false dichotomy. It's not mutually exclusive. You can actually, in many places you will see a hybrid approach where you choose some principles, you articulate what those principles mean in a certain set of circumstances with rules, but you have both. But I think at the end of the day, a regulator still has to decide, are we going to have an emphasis on principles or are we going to have an emphasis on rules? So here's an example, going back to our speed limit sign, of the great state of Montana. And so here you see they actually combine them. They differentiate between daytime, where cars can go reasonably imprudent, and they also and nighttime, where they have the strict speed limits. Why? Because at night, right? There's lower visibility, maybe there's more use of alcohol and driving at night, and therefore you have more The other thing they differentiate is between trucks and cars. Harder for trucks to slow down. Therefore, trucks have a rule-based, cars have a principles-based. So we see this also in financial regulation. One of my predecessors said the following. He said, a principles-based approach doesn't obviate the need for rules. Rather, a principles system is a hybrid of desired public outcomes complemented by specific rules at achieving those ends. The bold language, each authority, depending on the maturity of its markets, will need to find the optimal balance between the flexibility of principles and the legal certainty provided by rules. And so, depending on the maturity of the markets is sort of the closest any regulator that I know has come to at least identifying some factor you might consider. Well, I would propose to you there are at least 4 categories of things that you should look at. The first category are your regulatory objectives. The second, the nature of the market and actually the subject, what are you regulating? Third would be the attributes of market participants. Who's in your market? And then finally, you've got to look at yourself if you're the regulator. So using these factors, or I would say these categories, what are the factors that lead us to choose principles-based regulation, where it makes more sense to choose principles? So let's take the first, regulatory objectives. Number 1, you're more likely to choose a principles-based approach if a chief objective is prudential supervision. So prudential supervision is where you're looking at the safety and soundness of institutions. You're looking at things like capital, margin, risk management, where one-size-fits-all approaches don't necessarily work. Second, a situation where you need quick action. Quick action's needed for standards or guidelines for market behavior. You've got to get out there with something. Well, rules take time. Specific rules take a lot of time. Principles can be fashioned much more quickly. A third factor would be, do you want the direct involvement of senior management in compliance? So no CEO, CFO, or even a general counsel is going to read 13,000 pages of regulation. But I'll tell you what, for our clearinghouses, we have 17 core principles. They're pretty easy. You can read them in about 5 minutes. I'm almost certain that every CEO, every member of the board, as well as senior management of all of our clearinghouses have read these core principles. So it's important. Also, another factor is if there are several different ways to achieve the desired regulatory outcome. So if we're talking about something like cybersecurity, where there's various ways that you can set up defenses. If we're talking about something like value at risk and various calculations, and there are a number of scientifically and analytically validated approaches, then you might apply a principle that at least requires them to do one or more of those. Second category would be the nature of the market, the subject matter. You want to use principles in a situation where detailed rules could be easily gamed. Remember the accounting example, the tax code. If you have a check-the-box situation and it could lead to disaster, you don't want necessarily, you want some principles in there to guide the overarching behavior. You also want principles where you have specific governing rules and processes will require updates, frequent updates. Think about things that require mathematical models and economic data. If you're continuing to have to change them, the average regulation probably lasts about 15 years. So we don't once we come out with a detailed rule, if it's going to be useless a year from now, we probably want to go with principles. Similar point, if the area of regulation deals with rapidly changing technology, again, more likely to use principles. And then finally, if the regulated market and its products are in the nascent phase. So in our area, we look at something like crypto assets versus red spring hard wheat, right? Red hard spring wheat, very different. It's been around for at least 30 years, the same type of contract. You compare that to some of the new cryptocurrencies. Again, in that instance, principles-based probably makes more sense for rapidly changing nascent industries. We also want to look at the market participants. So if the participants are more sophisticated, you're dealing with institutional markets. That's one of the big reasons why the CFTC has largely been principle-based. Closely related to that point is information asymmetry between the participants. Again, if people can look out for themselves largely, then you can go more with principles-based. If there's a natural asymmetry between certain groups in the market, then you may need more detailed rules. Also, participants have extensive internal compliance functions. If they're pretty sophisticated, they have internal compliance functions, you can rely more on principles. And then finally, if participants are subject to a self-regulatory regime. If there's an SRO there, like the one that Bob Glauber ran, where they're close to the industry participants and everybody agrees that there's certain standards of behavior, then the regulator doesn't need to necessarily dictate specific rules. Finally, we look at ourselves. If there's a high level of trust between and frequent interaction between the regulator and the regulated entity, and we're constantly interacting with them, that's a place where you're more likely to use principles. If there's information asymmetry between the regulators and the regulated entities, so here what we're talking about is when the regulator can't possibly know as much as the people we're regulating. We don't want to have specific rules in that case. We want to rely on more broader general principles. The private litigation point. If there's not a lot of private litigation, then we're more likely to use a principles-based approach. And then finally, if it's an area where we're coordinating, these are cross-border markets, and we need to coordinate with our overseas counterparts, we're more likely to use principles-based because they're more like international standards. So those are the instances where I'd say you'd want to use principles. We would use the same categories in thinking about when you would use rules, and many of these are just simply the reverse, though there are a couple that are unique. So first of all, if your objective is market conduct or disclosure, more likely to use rules-based. If clarity is really important, you want to use rules-based. If the regulation targets behavior that is generally malum in se, that's just Latin for bad in and of itself. Everybody agrees we don't want falsifying documents. We don't want unlicensed people. Well, there you can write rules. You can clearly write rules to address those situations. And finally, if there's just one way to comply with it, why not write a rule, like registration, for example. Looking at the second category, the nature of the market, the subject matter. You're more likely to use rules if, number one, broad principles would just lead to confusion. There are some areas where it's just going to be confusing. The market really needs clarity. Secondly, specific processes governing behavior would likely stand the test of time. Okay, so we're not worried about things rapidly changing. Anytime you're dealing with disclosures or standard forms, any kind of standardization, we want to use rules. And then finally, if you've got mature markets, they're more likely a candidate for rules-based. We'd look at the market participants, the third category. Well, if we've got a situation where we've got consumers, retail investors, and other unsophisticated participants, and there's asymmetry that's natural, we're going to use rule. And these 2 points may be the very reason why we have a difference between the CFTC and the SEC historically. Also, again, sometimes participants say, I don't want flexibility. I don't want to have to choose. I just want consistency and I want transparency. In those instances, when you can, you would use rule-based. And then finally, if there's no self-regulatory regime. And then lastly, I would say we again look at the qualities of the regulator. If we don't interact with market participants regularly, we see them once every few years, we're going to probably rely more on rules because we can't check up on them and have interaction to determine whether or not they're complying with our principles. This one is a bit counterintuitive. If the regulator must coordinate its regime with one or more domestic regulators, you're more likely to be rules-based. Any idea why that is? Well, number one, our regulators, fellow regulators like the SEC, are pretty rules-based. So if they have a rule-based regime and we have a principles-based regime, we have the potential for regulatory arbitrage right here in our own country with very similar products. So generally speaking, we would actually be able to do detailed rules. Finally, the private litigation point. if private litigation is used, we don't want an odd situation where rather than the expert financial regulator setting the rules, we have a patchwork of courts around the country that are deciding this is, 38% is a reasonable way to charge interest, and we have just sort of a patchwork. It needs to be the regulator themselves. So the private litigation plays a role. And then finally, the regulated market has little connection with overseas markets. So we're not worried as much about regulatory arbitrage overseas, and things like consumer finance are great areas where there's not going to be a lot of spillage overseas, buying houses, mortgages, and things of that nature. So that, in a nutshell, are some principles for rules and for rules for principles. And now we have the pop quiz. Real life situations in the derivatives markets. And so I'll give you an area, and I'd like you guys to sort of think about whether you choose a principles-based approach or a rules-based approach. And I'll explain to you what the area is if you're not familiar with it. So the first area is automated trading. So these are real areas where the CFTC is grappling with today. Automated trading is brought about because it used to be that 20, 30 years ago, we had lots of people screaming and shouting in the pits trading. Now you go to the pits, to the extent they still exist, they're essentially television studios. Very powerful computers with sophisticated algorithms are doing all the trading effectively. There's still human beings involved with the process, but essentially you have, in certain circumstances, thousands of bids and offers being placed in milliseconds. So there are many good things that have come out of automated trading. We're seeing spreads narrow. It's created more liquidity. But if any of you remember the flash crash in the equities market, for example, there are some concerns. There are risk concerns. So that's sort of some background. Let's think about this issue. We've got rapidly changing technology. We've got asymmetry between the regulators and the regulated. These computer algorithms are really hard to understand to the extent we can understand them at all, being regulators. I think there's a sense that we should do something relatively soon. This is an area where I think we want senior management to understand the responsibilities of their automated trading operations to the extent they have them. And it's an area where I think there needs to be international coordination, since you can create a trading operation pretty much anywhere. So do you think this is more principles-based or rules-based? If you were in my shoes. Principles. That's right. I think that's exactly right. So next, again, showing the diversity of our market. That is the oil derrick. When you have a futures exchange, one of the concerns you always have is the issue of corners and squeezes. When you have a physically settled derivatives contract, you basically buy everything up, you've got market power, and you can squeeze at the end. To address this issue are position limits. So position limits basically say, at any given time in, let's say, the spot month, the final closing period, you can have no more than X contracts of open interest, either on the buy side, the bid, or the offer side, the short or the long position. And we apply these to energy contracts, metals contracts, and so we're talking about a very specific number. So you need to know in advance. It needs to be very clear. This is a very mature industry for the most part. And the various contracts that we're talking about are pretty much domestic. So we're talking about West Texas Intermediate, which is the other type of major oil traded around the world, like Brent, that's North Sea oil. We also have the various types of spring wheat, winter wheat, and we also have, let's say, natural gas contracts, which are based on delivery at Henry Hub in Louisiana. So what do you guys think about this one? Position limits, more rule-based or more principles-based? Rules-based, that's right. All right, we got two more. Cross-border, and there's a couple of cross-border issues, but I'll just deal with swap dealers, for example. We have to identify which swap dealers should be registered with the CFTC and which swap dealers should not be registered with the CFTC, but to the extent they're not, how rules should apply. So this is a tricky one. And so I may just sort of give you the answer, and I think it has to be a hybrid approach, which is we have to be very clear up front about who's in and who's out, how you calculate who is a swap dealer. But once we decide that, depending upon where they're from, what country, if they're based in another jurisdiction, then we may apply a principles-based approach. So this is one where I think it would be a mix of the two. And then finally, perhaps the most exciting one of all, which many of you who are students know far more about than me, crypto assets. So crypto assets is very interesting. Obviously, it's in the nascent phase of its development, I think. It remains to be seen, but it hasn't been around that long, certainly not as long as the other commodities I deal with. There needs to be international cooperation. There's changing technology. What do you think about this one? I think that's right. But one day, if the market develops, we may end up seeing a hybrid approach. But I think that's exactly right. I think there is a need right now in the market for some principles dealing with crypto assets. So you can see that although this was somewhat academic during part of the presentation, it actually has real-world implications. And unless we take the time to really think about it, what should we use, we could end up spending a lot of time on things that could be ineffective. So in closing, I would like to say, earlier in the presentation I mentioned that, that the mission of the CFTC is to promote the integrity, the resilience, and the vibrancy of U.S. derivatives markets through sound regulation. And I told you that at least from my standpoint, I thought sound regulation was about doing the right things, using the right tools, at the right time, for the right reasons. And so I thought I would end with one of my favorite quotes by JFK, after whom the school is named, as well as the forum here. And it's this: let us not seek the Republican answer or the Democratic answer, but the right answer. Let us not seek to fix the blame for the past. Let us accept our own responsibility for the future. While I hope today that at least articulating some principles for rules and from rules for principles, I've at least gone in a step in the right direction to focusing on that right answer. And I hope that in so doing, I've perhaps shed a little light in making a little sense of financial regulation. Thank you very much. Thank you. Thank you very much. Thank you.
Thank you very much, and thank you for respecting this institution. You delivered a talk which had extraordinary content, is extraordinarily provocative, and talked about issues of public policy. That's the most we can hope for here, and we, I think, all greatly appreciate that. I'm going to, rather than pose a question to you, I think what you said is sufficiently provocative. Let me start by just calling on people.
Sure.
Ask you questions. I've got a couple that I'll ask at some point along the way, but let me start with them. There are microphones on either side down here and a couple up above as well. Please.
Thank you very much. Paul
Could
Sheard.
you, ground rules, could you identify yourself?
Yes, surely.
Thanks.
Paul Sheard. I'm a senior fellow in the Mossavar Rahmani Centre for Business and Government. It's sort of a two-part question, Chairman Tarbert. One of the themes was that the SEC is rules-based, the CFTC is more principles-based. In terms of that hybrid kind of spectrum, presumably they're not completely polar. I mean, could you give us some sense of the extent to which they really are very different, or they sort of come together somewhere in the middle? And kind of related to that question, nowhere in your talk, unless I missed it, did you talk about how the underlying legal framework or system itself might condition the extent to which you could actually choose one or other of the systems? And I came into this lecture sort of thinking more in terms of different countries have got different legal systems and therefore would be more inclined to have a rules-based or a principles-based system. So if you could give a little bit of insight into, for example, if you wanted to be much more principles-based, to what extent the US legal system would constrain that optionality.
Great.
Give you the center stage.
I'll get to the center stage. Well, thank you very much. So 2 questions. The first question was basically the SEC and the CFTC I think traditionally most people say rules-based and principles-based. Both are hybrid regimes, but I would say that over the years the CFTC has emphasized much more about core principles and then derive rules from there. There are areas where the SEC has principles, but again, I think by the nature of its regime, disclosure, standardization, it's had to go more rules-based. The second question about sort of countries versus countries, I do think there's something there, and to some extent it may be embedded in the presentation, which is one of the big factors is private litigation. And so I know a number of people had said that on the disclosure side, for example, it's much harder for the United States to have a sort of a principles-based approach to disclosure because there's a lot more private rights of action embedded in our securities laws. So I do think that sort of plays a role. Now that said, I do think regulators can look at all these factors, and there is room for choice in both. Certainly in the statutes governing us, I would argue in the Bank Holding Company Act, in the Federal Reserve Act, the Federal Deposit Insurance Act with banking regulators, and I think there's even some room in the securities laws as well if you wanted to move to more principles. But that said, there are these other constraints that deal with market participants, that deal with the regulator, and that also deal with the products.
Yeah, please.
Hi, Jim Coburn from Ceres. So I was happy to see the CFTC announce a subcommittee that will address climate risk to the whole economy and think about the whole financial system and how it can be improved to address that, and related initiatives around the world like the Task Force on Climate-Related Financial Disclosures and the Network of Central Banks on Greening the Financial System. So I'm wondering, what do you think the role of the CFTC is in assessing climate risks to the whole economy and improving corporate disclosure on the risk?
Thank you. So we look forward to that. The subcommittee has just been created, and they're going to work on their reports. One of the things I think is worth thinking about is, to the extent there are specific risks, whether the derivatives markets could allow affected companies, affected countries, affected regions to hedge against that risk. So traditionally the derivatives market, and this is another thing where it's different than the SEC. The SEC's focus has traditionally been on investor protection, on capital formation. The CFTC's markets exist primarily for risk management and for price discovery. So that first issue of risk management, it may very well be that to the extent there are specific climate-related risk, it could be that derivatives markets could innovate to potentially address those risks.
I'm Devika. I'm a concurrent degree candidate doing my MPA here, my MBA at Wharton. I'm curious to hear what your perspective is on, so one of the things I think that's most interesting about regulation is that you don't really know if it's sound until it's been exposed to be unsound, right? So what do you look for in terms of signals that you would help you identify when like a regulation is beginning to falter and when it's too late?
Great question. So if we could go back to that slide with the wave and the regulator standing under it, that's essentially encapsulated in a nutshell the situation that we face. One of the things that I have found is we do a lot of thinking about potential risk that we're not facing today but could face in the future. So we do that at a national level at the Financial Stability Oversight Council, where we identify potential vulnerabilities in the financial system and said, if this happened, what then? So that's one way we do it. We also do it internationally. So I find that the Financial Stability Board, for example, is a great area where sometimes where something has been unsound in one jurisdiction, that can be shared with us. So we say, well, wait a minute, we're doing that here. We should take a look at it. So I would say a lot of it is you can't know the future, but if we can learn from each other's experiences and at least talk about potentialities, that is very helpful. Thank you.
Yeah.
Hi, my name's Zach. I'm a senior at the college. There's a case in the Supreme Court this term about the CFPB, and some people have suggested that the court might be willing to overturn Humphreys Executor, which is the basis upon which independent agencies in the United States are formed. You clerked at the Supreme Court. I was wondering if you have any thoughts on how you think this case might go, and if Humphreys Executor is overturned, would that impact the CFTC's ability to apply this principle-based regulation if commissioners could be removed at will?
You know what? So thank you for that question. One of the things that I did during my clerkship year was that Justice Thomas would, every Friday, the justices would meet and they would decide the cases, and he would have a vote sheet. And he would then sit us all around, and we had worked on the cases, we had talked to the other chambers, and he would say, all right, tell me, he would announce the case, and he'd say, how did it come out? And we'd say 5-4 reverse, 3, and we all had different answers. And then he would inevitably say it, and we were wrong. So one of the things that I noted is that it's very hard to predict the Supreme Court. So if I were, then maybe I would run a hedge fund that predicts Supreme Court decisions. So I honestly don't know. What I can tell you is the CFTC has a pretty good sort of a degree of independence, but at the same time, we work closely with the executive branch agencies, with the Treasury on the FSOC, with the Federal Reserve, with others, both not traditionally part of the Title V, which are part of the executive branch, but sort of semi-autonomous agencies, like, for example, the Fed. I wouldn't expect that to change regardless of what happens. And I want to be very clear, the CFTC, fully constitutional. Thank you.
Bill?
Bill Poorvu, Professor Emeritus at the Business School. I think it makes a lot of sense what you said about cyber currencies and how that should be principle-based. Can you tell us some of the principles you'd use to regulate that market?
Yeah, so in many ways, what we're thinking about now, we don't have any sort of principles in force now specific to cyber, but what we're doing is we're taking our core principles that currently exist and applying them to those cyber exchange, those digital asset exchanges and digital asset clearinghouses that come before us. So let's take, for example, margin requirements. Derivatives, of course, are leveraged. And there's a question there. Well, how do you get the margin right? The initial margin, the variation margin's a little easier, but the initial margin, well, and collateral. What collateral is. So one of the things that we're seeing in our markets that has gotten us comfortable is many of the products that are trading are fully collateralized. They're 100%. So you don't have that leverage there that we have in our more mature markets. Another issue that we're talking a lot about, and we're still thinking about how to address it, is the issue of custody. Right? So when you have a physically delivered forward and it's aluminum, okay, fine, we've got a warehouse in Detroit. It's unlikely someone's going to steal 200 million tons of aluminum overnight from the warehouse and make off with it. But when we think about digital assets and keys and wallets and all this, it's a lot tougher. So I would say that at this point, we're thinking through those types of issues.
And how would you answer Mr. Zuckerberg about his currency?
I'd say, so that is really interesting because we're still studying it. All the regulators are, because I think, so first there's the issue of a stable value coin. Now, right now, if an asset is backed by a commodity, and it likely would be under our jurisdiction, but there's a whole host of questions there, not only because you've got the backing issue, and so some of the potential run risk and other things that we're starting to talk about, the G7 report, but the interesting thing about that particular digital asset is the potential scope for it. I think for the first time, there's the possibility of a global stablecoin, and that raises a whole host of additional issues: monetary policy, systemic risk, etc. So that one we're very much still working through, and we're still trying to figure out exactly what it is and what it does. Thank you.
Let me pursue cyber currencies a little bit further. SEC and the CFTC are both involved. How is the terrain divided up, first? Second, what have been the differences in approach enunciated so far? And what do you see as the major risks in the regulation?
It may be so this gets a little complicated. So I'm going to try to boil this down to its essentials. I'll actually start with the last question, which is the risk. Apart from the subject that we just talked about, the possibility of a global stable coin, systemic risk has not really been an issue. And in fact, the Financial Stability Board thought about digital assets, cryptocurrencies, whatever people are calling them. I prefer to call. I generally don't use the term currency because that connotes a bunch of other things. But or you could. They're by and large the two major problems thus far with the vast majority of crypto, or I should say issues, are number one, anti-money laundering and counter-terrorist
Yes.
financing.
Yes.
So these are things that could, if done wrongly, subvert our AML CTF rules. And so we recently issued a statement that was joint FinCEN, the SEC, and the CFTC 2 Fridays ago, essentially saying, if you are one of our regulated entities, and even if you're not dealing with products that we regulate, but you're dealing with digital assets, cryptocurrencies, et cetera, you've got to apply the anti-money laundering laws, the Patriot Act, et cetera,
Okay.
to those. So we were very clear on that point. The second issue has been investor protection. These ICOs, people are issuing these so-called, cryptocurrencies, assets, and they may be nothing more than fraudulent schemes. So those are the issues thus far. Jurisdiction. Here's how it works. If it is a commodity, it falls within the CFTC's jurisdiction. If it is a derivative on a commodity, then we regulate it and we also have enforcement authority. If it's just a commodity, we don't have necessarily regulatory authority, but we do have enforcement authority for fraud and manipulation. Because if you had fraud in a commodities market that was not on a futures exchange, it could nonetheless affect the stability of the futures market. So we have that bifurcated. That's the first technical thing. So we theoretically can go after cryptocurrency exchanges that are selling and related in the United States that are not registered CFTC exchanges and would not necessarily be required to register with the CFTC. But if there's fraud and manipulation occurring because it affects our markets, we theoretically have enforcement jurisdiction. SEC versus CFTC. Commodity versus a security. The commodity definition is very broad. So in fact, it's so broad that movie tickets are carved out of the definition of a commodity. And as a technical matter, a security is a commodity. But once it becomes a security, it gets kicked out of CFTC jurisdiction and is an SEC jurisdiction, except for a very technical area, which is if it's a securities future, then it comes back in, and we have joint jurisdiction. So the first question is really, whatever you have, whatever digital asset you have, is it a security? And there is a 4-part test that the SEC uses to determine it. I'm not going to go into it now. It's called the Howey test. But essentially, the difference boils down to effectively, are you investing in something that is sort of an asset, a store of value in and of itself? Or are you investing in something whose value is based on the efforts of others?
Okay.
So that's the way it works. It's much more complicated than that, but that's the big picture.
It's complicated enough. Please. Or if I beg your pardon, please.
Your presentation in general is clear, and I'm wondering about, even for a situation where you need an hybrid approach. So I'm wondering why in your applications you didn't come up with an example where actually there was a mistake. If there was a case, there's such a case in history where it should have been a principle base and you actually had a rule base, or the other way around. And the other question is, are there situations where you actually would use a rules approach while you should have used a principle approach, but you choose the rule approach either to incite the market or rein in on the market, and the other way around?
Yep. Part of the reason I haven't used examples is that many of them dealt with other regulators, and I thought that might be a little unfair. What I will say is that one of the areas we did point out, which is where a rules-based approach was used, where arguably it should have been a more principles-based approach, was this idea of the bankruptcy remote vehicles under the accounting rules and moving stuff off the balance sheets. There, I think, we had a situation where a lot of assets were quote-unquote moved off the balance sheet, but then, and people thought that they were following the letter of the law, the letter of the rules.
Of the financial accounting rules,
the
right?
financial accounting rules, but then, of course, everything collapsed, and it was very clear that they did have an obligation, or at least asserted they had an obligation, and there was a lot of unknown liabilities. So that would be an area.
Well, just to take that one step further, under U.S. accounting rules, which are rules-based, or U.S. accounting standards, which are rules-based, indeed, taking them off balance sheet was permitted. Under international accounting standards, which is principles-based, they would not have been able to take them off balance sheet, and they would have remained on. So it really does make a difference. And the problems that occurred because of the special purpose entities back in 2007 really did turn on rules versus principles.
That's right. And to your second question, sort of dealing with, well, would you do a rules and not a principle, even though you should do a principle? One of the things you can do is you can create a general principle that says, look, this is what we expect of you. But you can also create a rule that provides a safe harbor that says, but if you do this, you're okay, and you don't even need to come back to us. So sometimes that's why a hybrid approach, I think in most instances, is the way to go, but you're always going to emphasize one or the other.
Good. Yes, please.
I'm Brajesh Pandey and graduate student, Kennedy School. My question is a little different, but asking you as a regulator, that you are a regulator, goes back to the almost 10 years back when global financial crisis happened and people lost job, millions lost their wealth. So, but like when Lehman Brothers collapsed, it did not collapse in one day. Their balance sheet would not have deteriorated in one day. But if you go, I mean, even 1 month back or 3 months back, rating agencies used to grade their balance sheet at the best. So do you feel that as a regulator, I mean, probably these rating agencies got away very easily without any significant accountability for this crisis?
Look, I definitely think there were problems with rating agencies, and so there's no question about that. You know, yeah. So I do think the ratings were clearly wrong. They clearly didn't take into account a number of factors that they should have, like correlations, and as a result, a lot of assets were mispriced. The risk was mispriced. So there's no question that the rating agencies got a number of things wrong.
As a regulator, they should have been, I mean, their accountability should have been fixed by SEC.
Yes, that's the SEC's jurisdiction. What I will say, but back to the, I mean, one of the things that so I can talk more about my own jurisdiction was that there was no problem with the futures contracts of Lehman. So Lehman collapsed, but because the futures markets required initial margin and variation margin, all those positions were collateralized in a way that the credit default, the swaps market was not. So we were able to close out those positions. But yes, no question about the rating agencies being part of the issue.
Yes, sir.
Oh, okay. I think
Okay.
Please, my
Hello?
apologies.
Okay. Hi, sorry. I'm Ara Omoto. I'm a sophomore at the college. I wrote my question down. But so given the CFTC's definition of a qualified eligible investor, do you think that there should be adjustments made to like what seems to be the arbitrary definition of an accredited investor?
Yeah, so I think accredited investor is an SEC term, but we have the eligible contract participant, and we have it in ours. So one of the things that we're looking at, and in fact, I think you may likely see legislation on this, is that it hasn't been updated in a number of years. So I think it's something like 15 years. So we're still using, and it makes sense. So I think the essential assumption is, if you have a decent amount of experience as well as wealth, then you can enter these markets in a way that maybe perhaps someone that's much more unsophisticated, a retired person with a very small, Social Security coming in, some of these products are not suitable for them. And so we restrict the swaps markets, for example, to mainly institutional investors and maybe people that are of means. But one of the issues is that the standards and have not been updated in a number of years. So we're still using income levels and wealth levels that haven't been updated for inflation or over time. So they probably need to be updated. Thank you.
Yes, sir.
Miles, I'm a senior at the college. I was wondering, you spoke briefly earlier about the fact that the CFTC and the SEC share regulatory authority in the securities futures markets. How exactly, like on a working level, do you delineate authority? Is it political? Is there some other body you look to? Or how does it actually work on a working level?
This is a great question, because the moment the CFTC was created in 1974 and came around in 1975, I think they were immediately sued by the SEC, or there was a dispute. Right. Because the Securities Act and the Securities Exchange Act say the SEC has a jurisdiction over securities, but our statute says the CFTC has exclusive jurisdiction over futures. So when you blended the two, so there was actually a disagreement, and the SEC chairman and the CFTC chairman had to sign an accord and
they
essentially
made a
said,
deal.
you were there for that,
Yeah,
right?
they made a deal.
And they said, we're not going to do anything. So for years, there were no single stock securities futures, which is the area where there's the overlap. And then finally, it was sorted out in statute. So we have joint jurisdiction. And so the very first rulemaking of my chairmanship in September, we actually set position limits for security, single stock security futures on our exchanges to be the same as that of the SEC. So there you have it.
Please.
Hi, thank you. My name is Daniel. I'm an LLM candidate in HLS. I want to quickly touch base on a point you briefly mentioned regarding private litigation. It's clear that a principle-based regulation risks unwanted judiciary interpretation. However, a specificity view suggests violations of rule-based standards and increase the probability that a suit will be successful, and thus, by itself, increases the risk of litigation if it's rule-based. So I was wondering how the CFTC deals with both these scenarios when judiciary interpretation directly confronts the regulator's initial objective.
Yeah, so it's a great question. So it depends on what it is, and sometimes we will let the jurisdiction stand, or other times we will see an interpretation of one of our rules, for example, or one of our principles, and we will then correct it. But there is this issue, is that if you do a rule-based regime, it can protect you against private litigation, assuming you follow the rules. If you don't follow the rules, then you really get nailed, which is your point, because then it's sort of prima facie evidence, perhaps, that you have violated the rules. So thank you.
And thank you. I think we've come to the end of our time. Heath, thank you. Have we one more?
Oh.
I'm sorry.
All right.
It's very nice to see you.
Please.
Oh, Paul Tucker, research fellow here. It's very nice to see you here, and it's very nice to hear an American official say something positive about international cooperation. Normally, American officials only say that behind their hands. I've got a question for you.
And I did have the picture of London as well, Sir
yes,
Paul.
yes.
So I saw
Lovely picture of London, Paul.
So you have presented rules and principles as kind of alternatives, and that is indeed how that debate has been played out over the past quarter of a century. And for what it's worth, for a little while now, I've thought that was essentially a mistake. That for those fields where, on the criteria you set out, you rely on rules, there is scope for abuse, either by the regulator or by the courts, because faced with the endemic efforts of the industry to find their way through the rules. If you simply set it at the level of principles, you are going to be accused, I don't mean you personally, but regulators are going to be accused, particularly here, of the exercise of arbitrary power, and probably challenged in the courts here as well. So what about a hierarchy of rules that are governed by principles? Where the principle, ideally in my view, the principles would be in statute and would govern the rules. And I mean, John Braithwaite has set this out from ANU, and I've set this out as well. The question I have for you, given that Congress certainly won't pass any legislation in this field for quite a while, is does the CFTC have the authority to pass high-level rules, which are principles, within which both you and the courts could be constrained to interpret the more detailed rules? The problem with detailed rules is that they are a game, and they are a game for the industry, and they are a game for you, and they are a game for the DC Appeals Court. The problem with not having rules is then you just have an open texture for people to do what they like. But does the CFTC have authority to construct a rules-based regime governed by higher level principle-like rules? Thanks, Heath.
Thank you. Yeah, so I mean, I actually don't think what you've said conflicts with what I've said because of the hybrid approach. I think in most cases you are, but there are, of course, situations where we can't come up with the rules right now, and so we start with principles and we may migrate to rules. There are ways in which I think in a rulemaking where we set out maybe general principles and some rules, we could circumscribe the manner in which we would interpret those. So I would think that in the preamble text to a regulation, we could say, we will not issue there could be a number of ways that we could do that. So I would say it is possible.
Good. With that, Heath, thank you so much.
Thank you. Thank you. Appreciate that. Thank you.